Good evening, everybody, and welcome along to our Q&A session on wills and tax planning. So I'm your host this evening. For those of you who don't know me, I'm Michael Cressy. I've been at Bracious for 10.5 years now, and I specialise in everything mental capacity, lasting powers of attorney, and court of protection. My guest this evening is Alexandra Gordon. Now, Alexandra is TRI qualified, as you can see from your screen in front of you. Alexandra is qualified as a solicitor, a chartered tax advisor, and also a notary public. On top of all of that, she's the president of the Kent Law Society. So we're in very safe hands this evening. And Alex, it's great to have you along with us.
Thank you, Michael.
The structure of this evening's session will last approximately 45 minutes to an hour. We'll be discussing wills, tax, and trusts. So before we go to the questions, Alex, can you briefly explain to everybody what wills and trusts are?
Yes, of course. Thank you, Michael, for the introduction. So let's start with wills. So a will is a document, a binding document that you put in place, and it covers three main points. So quite obviously, it covers what happens to your assets on death. It also deals with who you appoint as your executors. Now, this is a really important clause because the executors are the people who are authorised to deal with your estate. So it needs to be someone that you trust to follow your instructions in your will. And then finally, if you have minor children, it's a brilliant place to put in a guardianship clause for them. Now, with minor children, if something happens to both parents, then normally what would happen is the children would live with or go to be looked after by relatives. And whilst the court would look at that and normally let that continue, there are cases when the court will put children in temporary accommodation whilst they decide who is best to look after the children. So it is a very important clause and probably the main reason you would put a will in place if you do have minor children. Trusts. So trusts can be put in place in your will, or you can make them during lifetime. Now, a trust is a structure which you put assets into, and it's kind of a protective wrapper around those assets. You have trustees, and they are like your executors, they're in charge. So it's up to them who gets money and when. You as the settlor of the trust, or if you've made a will, the testator, you're the one who's giving your instructions to your trustees. So you'd normally find a letter of wishes alongside a trust, which would set out the reasons why you put the assets into trust and when you would want them passed to your beneficiaries. There are two main types of trust, a life interest trust and a discretionary trust. Now, a life interest trust gives someone the present right of enjoyment over the assets in the trust. Now, this would mean the right to live in a property, if there's a property in the trust, or the right to the rental income that the property could be generating. If there are bank accounts or investments in the trust, then it would be the income, the interest, the dividends that the assets were producing. It would make sure that the capital is protected for the remainder beneficiaries. The second main type of trust is a discretionary trust. And on this one, all of the assets are put in this protective wrapper, and it's up to the discretion of the trustees as to when they distribute monies to who and how much. And that is when that letter of wishes is really important, because you would put all of your wishes in that. And again, you would want to make sure that your trustees are people you trust to go along with your wishes, so that they would deal with the assets in the trust in line with in accordance with your wishes.
Excellent. Thank you very much for the introduction there. We do have pre-submitted questions which you kindly submitted on registration. However, on your screen, you should find a questions box. As we go along, if you think of any further questions, please do pop them in there. And if we have time at the end of the session, we will come to those at the end. So just moving on to our pre-submitted questions now, Alex. The first one here, which I have: if I'm happy for everything to go to my wife and then subsequently my children, why exactly do I need a will?
So two reasons for why you should make a will. The first one is not actually to do with the will at all. When you have a will meeting, what you will find is the advisor will run through all of the assets that you have in your estate. And that's really important, because you can have assets in your estate, for example, property, which won't ever pass via your will. So, for example, most married couples will own their property as joint tenants. And that means on the death of one of them, the property will automatically pass to the survivor, which means the property will never pass via your will. So that's really important, because that may be what you want, but that may not be what you want. So we would run through all of the assets and work out if they are set up correctly. And then we would look at the terms of your will. When it comes to the terms of your will, if you want everything to go to your spouse and then your children, it may happen via the intestacy provisions, so you may not need a will, but it also may not. And it's worth bearing that in mind, because if you don't know what the intestacy provisions are, you need to really think about why you've chosen them to deal with your estate. So for example, for married couples, it's only the first £270,000 of an estate which goes automatically to the spouse. And again, don't forget, this is ignoring any assets that automatically pass, so don't go via a will or intestacy. So the first £270,000, anything on top of that is divided 50-50 between the surviving spouse and the children. So you could end up with part of your estate passing to your children rather than your intended spouse. Now, that may not be a problem for you, but obviously it does make things a little bit tricky, especially if we want to ensure that assets pass with spouse exemption, which means they're free of inheritance tax. But also as well, the intestacy provisions say that children inherit at 18, which most people think is too young for children to inherit, especially if they're inheriting quite a large sum of money. Also as well, there will be no guardianship provision. So it's always best to make a will, because then you've got certainty. You know exactly what you want to happen is going to happen should anything happen to you.
Excellent, thank you very much. And the second question tonight here, Alex, is why would my parents have left their estate into a discretionary trust if their children are all adults?
So when you meet with a lawyer to discuss the requirements for your will, you have to remember that they're advising you on your current family circumstances, your current assets, and the laws in respect of succession and inheritance tax that are in place today. Now, a discretionary trust is a great vehicle. As we mentioned earlier, it basically puts a protective wrapper around the assets, and it's up to the trustees to use their discretion as to when to divide those assets and distribute them out. The great thing about a discretionary trust is it almost allows a wait and see. So you can put all of your assets in discretionary trust for, say, your children, put that protective wrapper around them, and then on the death of the survivor of you, your trustees will look at your assets, the circumstances of your children, and the current laws that are in place and decide what's best to do. Because the discretionary trust has this 2-year wait and see, where you've got 2 years basically to change it into whatever you want it to be. You can keep the discretionary trust in full or in part, you can wind it up in full or in part, or you can turn it into a completely different trust. And you may think, well, why would you want that? Well, a discretionary trust is great for beneficiaries who maybe are on means tested benefits, because it would mean that they wouldn't inherit a large lump sum of money. Also, if, and it's always the horrible things as well, sorry, it's a bit morbid, but if any of your beneficiaries were divorcing, were in bad debt, or were very ill and were likely to pass away very soon, you've got the risk that if you left monies to them outright, that money could quite quickly end up with someone else, or maybe away from the family. So the discretionary trust allows that wait and see to decide who's best to give money to and at what time. Also as well, that 2 years really helpful, because normally a discretionary trust has inheritance tax. It falls into inheritance tax regime, where inheritance tax is paid every 10 years and every time money is paid out of the trust once it goes over a certain amount. That 2-year wait and see, there are no inheritance tax penalties or charges that apply. So you know you've got 2 years of safety to make a good decision as to what should happen with the monies. Also, if, for example, one of your beneficiaries was wealthy in their own right and had just done their own inheritance tax planning, the last thing they may want is to inherit a lump sum of money from their parents. They may instead want to leave their share in a trust and have the monies loaned to them instead, or they may want their share redirected to their own children, or kept in the trust to pay for children's deposit on property, school fees, things like that. So it allows a lot of flexibility. It's not something that's put in place because of distrust. It just allows flexibility, because obviously none of us know when people are going to pass away, what they're going to have in their estate. what the circumstances of everyone will be, and also what the law will be at that time.
Excellent, thank you very much. And the next question we have here is the limit for inheritance tax £1 million for everybody who owns property?
So I'll just set out the inheritance tax allowances that we have in place at the moment. So everyone has an amount called their nil rate band, which is £325,000. So every individual gets that amount. If you are married, and as I mentioned earlier, if you leave anything or everything to each other, you do get spouse exemption, which means there's never inheritance tax to pay, and therefore you wouldn't use up your nil rate band allowance. But what can happen is on the death of the survivor, they can use their own nil rate band allowance plus the nil rate band allowance of the first, so that together they have £650,000 to give away free of inheritance tax, which is what's normally done. A few years ago, we had an additional allowance come in called the residence nil rate band. Now, this is only available to those who own property, so that is true, but you also have to have children who the assets will pass to, and your estate has to be up to £2 million to benefit from the whole residence nil rate band. As soon as your estate goes over £2 million, you will lose £1 of the allowance for every £2 your estate goes over. So that extra allowance is £175,000 each. And again, it is transferable like the nil rate band. So on the death of the survivor, you could have two of them, which is £350,000. So together with your £650,000 combined, you would have £1 million in total. So it's couples with children, with property, and with estates up to £2 million. And it also is equity in property. So if you've got a property worth less than £350,000, say for example 300, you would only get £300,000 of the allowance. So it's up to, depending on the equity in your property.
Excellent, thank you very much. And next question, is it true that once you survive a gift by a certain amount of time, the value of the gift reduces for inheritance tax?
So this is something that's always asked, because the rules aren't quite clear on it and people do get confused. So as a general rule, if you want to make a gift, you must survive it by 7 years for it to be completely out of your estate for inheritance tax purposes. So if we use the nil rate band of £325,000, if I was to make a gift today of £25,000 to Michael, my nil rate band would drop from £325,000 down to £300,000. If, and I hope, once I've survived the gift by 7 years, actually I haven't got £25,000 to give you either, sorry. But once I've survived the gift by 7 years, then my nil rate band allowance goes straight back up to the 325. Okay, so if it's a gift of up to 325, you must survive the full 7 years for your nil rate band to go back up. It's if there's tax on the gift, that's where there is what we call a taper. So the value of the tax reduces, not the value of the gift. So if I were to make a gift of over £325,000 and die within 7 years, there would be tax on the value of the gift over that £325,000 at 40%, which is the rate of inheritance tax. Once I've survived that gift by over 3 years, then the value of the tax tapers. So after 3 years, my estate would only pay 80% of the 40% inheritance tax due, and so on and so on, until after surviving 7 years, there's no inheritance tax to pay at all.
Okay, great. Next question we have here is there any way to secure my mother's property or inheritance so that she won't have to use it for the cost of a care home, etc., if needs be?
So this is a really common question that we get asked, and you have to be really careful with giving away assets, especially property. And there are three main reasons for this. I'll come to care last. The first is if you are giving away, for example, if I was giving away my property to my children, but I still lived in the property, then I've not made a gift for inheritance tax purposes. That 7 years hasn't started running. So for inheritance tax purposes, the property is still in my estate. So I've not made any difference to the value of my estate for inheritance tax purposes. Secondly, you've got to be careful gifting property to anyone. And whilst it's not something that our children would do on purpose, but if any of the people who you gifted the property to became divorced or became bankrupt or passed away and left their assets in their will to someone else, then you are living in a property that is potentially now owned by your child and a third party. And if that third party wants their money out of the property, then you've lost all security you have in your house. So we always recommend don't touch your main residence if you can avoid it, because you need security. Then coming to protecting money from care home fees, again, you have to be really careful, because if you put assets out of your reach because you want to avoid paying care home fees, then the local authority can ignore the transaction and get monies back, because that's an intentional deprivation of assets. And the local authority will look into these gifts and they can look back as long as they like. So it's not worth it normally, but we're always happy to have a chat with people and discuss what assets they've got in their estate and what we can help with.
I think it's almost more important to have that specific advice tailored to you as opposed to sort of blanket general advice anyway, isn't it? On to our next question for you, Alex. If there is a discretionary trust on a property which is sold, transferred automatically to the new property?
So with a discretionary trust, as I mentioned before, the trust will own its own assets. So it may have a property in it, it may have cash in it. If a discretionary trust or a trust, any trust, is selling an asset, then whatever the replacement asset is will automatically be owned by the trust. So if it's cash proceeds, that is in the trust. If it's a replacement property, that will automatically be owned by the trust as well. It's only if the trust makes the distribution of the assets that they come out of the trust. And it might be that some assets come out of the trust to beneficiaries, or it might be that all assets come out of the trust and it's completely wound up.
Excellent, thank you very much. Next question we have here, is there a way to put investment properties into a trust as not to be used for healthcare expenses later down the line?
Okay, so similar answer to what we mentioned above, but just something else on the trust part of that. So if you are putting assets into a trust, you cannot be the beneficiary if you want the assets to be outside of your estate for inheritance tax planning. So if I was to put my property into the trust, I can't live here anymore. I can't take the rent that the property would generate. I can have absolutely no benefit from the asset. Otherwise, the trust becomes settlor interested, which means that I'm a beneficiary, even if I'm not taking anything from it, but I'm a potential beneficiary, and therefore the property will always be part of my estate for inheritance tax purposes. Even if I've gifted it to Michael, Michael's living there with his family, but maybe I'm taking the rent because I'm getting some benefit, or I'm named as a potential beneficiary, then it's still caught inside my estate for inheritance tax purposes. So same answer in terms of the healthcare expenses later down the line, but you just have to be careful. If you want to live in the property, then there's going to be a problem.
Excellent. And going on to our next question, I've been told that I can do a deed of variation and put my inheritance into a trust. Does this mean I can still benefit from the assets?
So this is a very common question as well. A deed of variation is something that can only be done within 2 years of someone passing away. So if someone's passed away and left you an inheritance, you have 2 years to put a deed of variation in place if you need to. So a deed of variation is basically redirecting the assets you would have inherited under the will. There's 2 different main ways of doing this. One is very simply, you can redirect the assets to someone else, for example, your children, your partner, whoever you want to. And that's not a gift for inheritance tax. We don't have that 7-year survival period because it's deemed as if the gift came from the will, so on death. So it's deemed as if the person who passed away passed that asset directly to that person. The more complex way of doing a deed of variation is placing or redirecting the assets into a trust. And as I just mentioned, normally if you set up a trust and you are a beneficiary of the trust, then it's what's called settlor interested, and therefore all of the assets are in your estate for inheritance tax purposes. A deed of variation is different because we are reading back to the will, and it's as if the person who passed away had set up the trust, and put the assets in, which means that you as the original beneficiary can still be a beneficiary of the trust without any inheritance tax consequences. And this is a great way of benefiting from an inheritance but not having it as part of your estate for inheritance tax purposes. So for example, the monies could be redirected into this trust. You and your family could be potential beneficiaries, so discretionary beneficiaries. And then what you could do is take a loan of the monies in the trust out to yourself, and you can enjoy the monies during your lifetime. So you get the benefit of the assets. On death, your estate will owe that loan, that money back to the trust. So that money is deducted from your estate for inheritance tax purposes, which is good. And then the trust can loan the monies to your spouse or your children, and the trust can go on as long as needed, or it can just be wound up and monies passed to the children at a later date. So it's a really, really, really good vehicle for placing monies outside of your estate for inheritance tax, but getting the benefit of them during your lifetime. One quick point on that is that you have to be careful in that I briefly mentioned this earlier, that trusts are kind of like us in that they have an amount they can hold free of inheritance tax, which is the same as our nil rate band, £325,000. So if you were redirecting assets into this discretionary trust under a deed of variation, or if you were setting up a lifetime trust or a trust under a will, the trust can hold £325,000 without any further inheritance tax charges. So you probably wouldn't want to put more than that in the trust. Once the trust assets go over that £325,000, then it falls into what's called the relevant property regime, and there are inheritance tax charges every 10 years and every time money is paid out. So that's normally best avoided. Another thing to bear in mind that if, I know this is quite specialist, but I'll just mention one more point. If, say, you and a sibling have inherited from an estate and you both want to do this, you both want to put in place that deed of variation into a discretionary trust, you have that £325,000 between you to share. So you only get half of it each if you want to do that. And that £325,000 is based on no lifetime gifts in the 7 years before the person passed away. If you've got lifetime gifts in excess of £325,000, then you haven't got the amount to then use after death. So it's a very, very good vehicle, but well, sadly, you can only put it in place if someone has passed away.
Excellent. And our next question for you, Alex, which we have here: if family circumstances were to change, how easy is it to change a will and a family trust?
So let's start with the will. Most lawyers will have your will as a Word document. So it's going to be very, very easy to make amendments to it as and when needed, as long as you have capacity. You can only make a will or make amendments to a will if you have capacity. Michael is a specialist on what happens if you don't have capacity, and maybe that's another Q&A coming up. So very, very simple, Word document, make the changes. If we've seen you recently, we can just make the changes very quickly. You can re-sign the will and it's legally valid again. If we haven't seen you for a while, we may want you to come in, we may want to discuss any changes in your circumstances, in your assets, just to make sure that the will is doing everything that it should be doing for you. But the general, how easy is it to change a will is very easy, other than the fact you do have to get a will witnessed by 2 people. So you can either come into our offices and do that, or if you've got friendly neighbours who are happy to do it, then that's fine. And we've seen that a lot during the lockdown period. When it comes to a trust, it really would depend on what the terms of the trust are. So it's normally very easy to change trustees. They can retire and new trustees can be appointed. That's not a problem. Normally you're able to add in beneficiaries, but you would just need to double check the wording, because sometimes certain beneficiaries are excluded from being added. And also, so you can normally add in extra assets. That's normally quite standard. But I mean, this is a question that's come in. So if you have a specific question about a family trust that's been set up, feel free to drop us an email and we can have a look at the terms of the trust and see what you want to do with that.
Absolutely. We've had some questions been asked of us as we're going through. One of which is, I last done my will 3 years ago. How often do I need to review and possibly change a basic will?
So we would say review your will every 3 to 5 years, because circumstances may change. You may have had children, you may have had grandchildren, your assets may have changed dramatically. So it's always best to review it. There also may have been a change in the law, which doesn't happen too often, but there are times when it does change, and normally when it does change, it changes dramatically. So it's always best to just drop us a call. We can have a quick review of the will, and if everything's fine, we won't change it. It's only if something important needs to be amended that we would. So for example, if you've moved house, or any of your beneficiaries have moved house, we wouldn't need to do that. Also as well, you should just bear in mind that marriage does revoke a will. So if you've got a will in place and then you have got married, it will have been made void. So you should review on any big circumstances that happen in your life.
Excellent. And the next question, which has been submitted here, excuse me, is there any minimum number for executors and trustees which I should be considering?
So trustees, I'll do that first because that's quicker. So you always have to have a minimum of two trustees for a trust. So for any reason you had one appointed in your will, the trust wouldn't fail just because there's one trustee. It would just be down to that trustee to appoint a second trustee to be able to run the trust with them. When it comes to the executors, there is no, well, minimum is one. There is no maximum, but you should just be aware that when it comes to property, you can only ever register up to 4 people on a title. So if the executors are looking after property, after 4 of them, they're not going to be mentioned on any titles to properties. We would normally say that if you're leaving everything to each other, everything to husband and wife, you may just want the survivor acting, because if something's happened to your spouse, you probably don't want anyone else getting involved, and you probably want to deal with it in your own time. So one person is absolutely fine. But at the same time, you may think, well, actually, I would like the support of one of my children to help me through. And if you would rather that officially, then they can be an executor with you, or they can help unofficially if you are the sole executor. When it comes to dealing with the estate of the survivor, if we've got minor children or we've got property, we need two really executors to deal with everything. You just got to remember that executors and trustees make decisions together. So the more you have, the more harder it is for people to agree on things. So two is a very good number.
Excellent. And just moving on to our final question of this evening, which has been submitted as we've been going along. From a non-biased point of view, is it better or quicker to do a will online rather than go through solicitors?
No, don't do it. There's many reasons not to do an online will. I'll recap on some of the reasons that we've mentioned. So one is that we won't just say to you, what do you want, and draft it for you. We will look at everything in your estate, and we will tailor that will specifically to you and your needs. So it's not you telling yourself what you want in your will, it's us advising you on the best things and all the different options that you can have. So you are putting your will in place fully advised. Secondly, we will go through all of your assets. As I mentioned with the joint property, we will tell you what assets pass via your will, what assets do not pass via your will, and what you need to do with them. For example, life policies, they can be written into trust so that they do not pass via your will, which means that they do not pass via your estate for inheritance tax purposes. So things like that we can advise on. If you've got foreign assets, different rules apply. So we can advise you on that and whether you need to get a will in the country where you maybe have foreign assets. Also as well, this has never happened to me. I'm touching anything wood that I can find, but if anything goes wrong, if you have done a handmade will, there is no one who you can sue to fix it. We have insurance. If anything goes wrong, we will fix it. Same with all law firms. It's very unlikely we will go anywhere. We've been around for 125 years. We've come out of COVID fighting. So if anything happened to us or another law firm, what happens is another law firm will buy out their will bank. So there will be another firm who take on the will. So there is never a problem if you appoint a solicitor, because there's always, I would imagine it's always going to be right the first time anyway, but worst case scenario, there is insurance in place. We really need to find some wood.
I really hope you just haven't jinxed yourself there. But that brings us to the end of the questions submitted to prior to tonight and throughout the session. If you do want a review of your will, we are always happy to have a look over. So please do get in touch. You can head to our website, quite clearly labelled wills and powers of attorney as well, and tax planning. As a private client firm, we do offer everything from wills, powers of attorney, trust administration, and also probate. So if you did have any questions, get in touch with either myself or Alexandra Gordon directly. That brings the session to a close. I hope you've all found it really useful and enjoyable, and we will be having a few more webinars in relation to powers of attorney and possibly probate later down the line. So hopefully see you all again soon. Take care.
Thank you.